An economic crash doesn't send a polite warning. It arrives as a mass layoff rumor, a falling retirement balance, a credit limit cut, or a grocery bill that suddenly feels personal. The threat is not only what markets do, it is what fear makes ordinary people do next. In May 2026, the Federal Reserve described equity valuations as elevated while calling banks sound and household debt risks moderate. That is tension, not proof of a scheduled crash. These 30 practical moves make sense before a recession, during a market drop, and even if the feared collapse never arrives. They can protect cash, reduce forced selling, sharpen grocery choices, and make a household harder to break. Start with a personal stress test. Imagine income falling, a major repair arriving, and stocks dropping at the same time. Write the minimum cost of housing, utilities, food, insurance, transportation, medicine, childcare, and required debt payments. Test that number under a smaller pay cut, the loss of one paycheck, and a longer disruption. You are not predicting disaster. You are finding the weak joints now, while calm choices are still available and every decision is not being made under pressure. That gap between comfort and survival is the number the plan must defend too. Next, perform a complete cash flow audit using actual statements, not memory. Pull several months of bank and card activity. Mark every recurring charge, irregular bill, annual renewal, fee, transfer, and purchase that you forgot within a week. Memory understates convenient spending because each transaction feels too small to matter. The total becomes visible only when it is grouped. Delivery fees, add-ons, unused memberships, and impulse purchases often form a second utility bill without announcing themselves. Separate expenses into essential, valuable, negotiable, and disposable. Essential keeps the household operating. Valuable supports health or earning power. Negotiable may be reduced. Disposable can stop. This prevents panic from cutting the wrong thing. Do not treat every expense equally. Canceling job software while keeping an unused entertainment bundle is not discipline. Skipping preventive medicine to preserve a luxury payment is not thrift. Good cuts reduce fragility without damaging your ability to recover. Repeat this audit before every major renewal. Companies benefit when customers stop looking. Your defense is attention. A budget is not a punishment document. It is a record of where your future freedom is being sold. Small leaks become serious when income slows and every renewal lands at once. It also shows which sacrifice protects the household and which one creates a new problem, a distinction that becomes harder to see when every headline demands immediate action. Build an emergency fund in layers instead of waiting for a perfect target. The first layer covers a sudden deductible, repair, or missed shift. The next covers core bills. The final layer buys time during a longer income shock. A common guideline is several months of essential expenses, but the right target depends on job stability, household income sources, health needs, and access to support. A single-income household with variable work usually needs more cushion than a dual-income household with stable contracts. Keep this money boring, accessible, and separate from daily spending. Emergency cash should not depend on selling stocks after a plunge. It should not be locked behind a penalty you cannot tolerate. Its job is availability, not excitement. Automate a small transfer after every paycheck. Windfalls can accelerate the fund, but consistency builds it. Even a modest buffer can prevent a flat tire or medical bill from becoming high-interest debt, late fees, and a damaged credit record. Name the account for its purpose. A label like Household Reserve creates a psychological barrier against casual withdrawals. You are not hoarding. You are buying the ability to say no to a bad loan, a bad job, or a panic sale. The reserve is valuable because it buys time before expensive choices become unavoidable. Check where cash is held. Standard FDIC coverage is $250,000 per depositor, per insured bank, for each ownership category. Stocks, funds, bonds, and crypto are not insured deposits because an app displays them beside cash. Do not assume every account with a familiar logo has the same protection. Some financial technology apps place money through partner banks, and coverage can depend on how accounts are structured and records are maintained. Read the disclosures and identify the actual institution. If balances are large, review ownership categories and concentration at one bank. The point is not to spread small sums across a maze of accounts. The point is to understand whether the amount you believe is protected actually fits the rules. Brokerage protection differs. SIPC can protect up to $500,000, including a $250,000 cash limit when assets are missing after a member firm fails. It does not reimburse normal market losses. Save copies of account titles, beneficiaries, contact information, and recent statements. In a stressful event, clarity matters. Protection systems work best when your records are accurate and your family knows where to find them. Protection depends on the account structure, not the reassuring look of an app. Keep a modest amount of physical cash for short disruptions. Payment networks, local power, fraud alerts, or a lost phone can temporarily block digital access. Cash is not a bet against the banking system. It is a backup for ordinary friction. Choose small bills and store them securely. The purpose is to cover fuel, food, medicine, or transportation for a brief period. Keeping an enormous pile at home creates theft, fire, and loss risks without earning interest. Do not advertise that you hold cash. Do not treat it as an emergency investment. Inflation slowly reduces purchasing power, and homeowners or renters insurance may limit coverage for currency. A backup should solve one problem, not create three more. Pair physical cash with more than one payment method. A second card from another network or institution can help when one account is frozen. Keep the spare away from your primary wallet so a single loss does not remove every option. Test the backup plan once. Know your personal identification numbers, update expired cards, and make sure a trusted household member can access essentials. A plan that exists only in your imagination may fail at the first locked screen. Redundancy matters most when the usual payment route fails without warning. Reduce fixed monthly costs before income is threatened. Negotiating is easier while you are calm, employed, and current on payments. Once you are behind, companies may offer fewer options and your choices become more expensive. Call insurers, phone providers, internet companies, and lenders. Ask for current promotions, lower tiers, competing quotes, and fee removals. Loyalty is often rewarded with silence, while new customers receive the attractive price. Review deductibles and coverage carefully. The cheapest premium can be a trap if the deductible would bankrupt your emergency fund or the policy excludes the risk you actually face. Lower cost is useful only when the protection still works. Cancel subscriptions that survive because cancellation is annoying. Companies understand inertia. Free trials become paid habits. Annual renewals arrive quietly, and bundles hide services you no longer use. Friction is part of the business model. Every permanent reduction has a double effect. It saves money now and lowers the size of the emergency fund you need later. Cutting a fixed bill is like giving your future household a small raise every month. Lower obligations create breathing room that no optimistic forecast can guarantee. Attack high-interest variable debt with urgency, but keep a starter cash buffer. Paying every available dollar toward a card and then borrowing again for the next emergency creates an exhausting loop. Liquidity and debt reduction must work together. List balances, rates, minimum payments, and whether rates can change. Then choose a method you can sustain. Highest rate first usually saves more interest. Smallest balance first may create faster psychological wins. The best method is the one you will continue. Call the lender before missing a payment. Ask about hardship programs, reduced rates, temporary plans, or due date changes. Get terms in writing. A promise from a rushed phone call is not a financial plan. Avoid debt settlement promises that sound effortless. Stopping payments can trigger fees, collection activity, credit damage, and possible taxes on forgiven amounts. Verify any counselor or company before sharing account access or paying upfront. When extra cash arrives, direct it intentionally. A tax refund or bonus can disappear into lifestyle spending because it feels separate from normal income. Assign it before it lands. reserve, debt, essential repair, or another defined defense. Debt charges keep compounding even when wages, hours, or confidence begin to fall. Protect your credit before you need it. Credit is not an emergency fund, but damaged credit can raise the cost of housing, insurance, borrowing, and deposits precisely when money is tight. Set automatic minimum payments where cash flow allows, then pay more manually. This reduces the chance that one forgotten due date causes a late fee. Keep enough checking balance to prevent the automatic payment from creating an overdraft. Review credit reports for accounts you do not recognize, wrong balances, and outdated information. Freeze your credit if you are not actively applying. A freeze can make it harder for an identity thief to open a new account in your name. Keep utilization under control by paying before balances become unmanageable, not by chasing a magical score trick. The real objective is capacity. Available credit is most useful when it remains available and you are not paying punishing interest to preserve it. Store creditor numbers outside your phone. If your device is lost or compromised, you should still be able to lock cards and report fraud. A resilient financial system includes a paper path back into your digital life. Credit should remain a backup option, not a monthly bridge to the next paycheck. Stop adding leverage when uncertainty rises. Margin loans, leveraged funds, options, and borrowed money can turn a temporary decline into a permanent loss because the lender or contract may force action before prices recover. The dangerous phrase is, "It has already fallen this far." A lower price does not automatically mean lower risk. A company can lose revenue, refinance at worse terms, issue more shares, or fail. Cheap-looking assets can become cheaper. Never risk rent money, tax money, tuition, or emergency savings on a short-term trade. Markets can remain irrational longer than your deadline. The calendar on your bill is more powerful than your opinion about valuation. Understand every product before buying it. Some funds reset daily, some options expire worthless, and some investments are difficult to sell during stress. Complexity often looks sophisticated until liquidity disappears. The purpose of preparation is to avoid forced decisions. Leverage does the opposite. It places a clock beside your risk and gives someone else the right to ring the alarm. A borrowed bet can become someone else's decision about when you must sell. Diversify across assets, industries, companies, and time horizons. Owning several funds is not automatically diversification if they hold the same giant companies. Look through the labels and inspect what you actually own. Match risk to when the money will be needed. Long-term retirement money can usually tolerate more fluctuation than a home down payment due soon. The closer the deadline, the less room you have to wait for recovery. Diversification will not prevent every loss. During broad sell-offs, many assets can fall together. Its purpose is to reduce the chance that one company, one sector, one currency, or one story destroys the entire plan. Be careful with assets marketed as perfect protection. Gold, real estate, bonds, cash, and digital assets each face different risks. No single asset wins in every inflation, recession, liquidity shock, or policy response. A durable portfolio is built around uncertainty, not prophecy. You do not need to identify the exact crisis. You need enough balance that being wrong about one scenario does not end the game. Real diversification is measured by different risks, not by the number of account lines. Rebalance according to a written rule, not a frightening headline. A market surge can quietly push your stock allocation above the risk level you intended. A decline can do the opposite. Rebalancing restores the plan. Check for taxes, trading costs, and account type before selling. In a retirement account, the tax effects may differ from a taxable account. In a taxable account, gains and losses can matter. Details change the best move. Do not rebalance every time the market twitches. Constant action can create costs and emotional mistakes. Use a calendar or a meaningful allocation threshold. The rule should be calm enough to follow during noise. If your portfolio is far more aggressive than you can emotionally tolerate, fix the design before a crash tests you. A strategy you abandon at the bottom was never truly suitable, no matter how elegant it looked in a spreadsheet. Write down why you own each investment and what would justify selling it. Price movement alone is not a thesis. A written reason makes it easier to distinguish new information from raw fear. Rules written in calm periods are easier to trust when headlines become frightening. Move money needed soon out of volatile assets before the deadline becomes urgent. A market decline is painful. A market decline just before tuition, closing costs, or medical treatment can be destructive. Create separate buckets for near-term spending, medium-term goals, and long-term growth. The labels are not cosmetic. They stop one goal from quietly borrowing risk from another. Cash and high-quality short-term instruments may feel dull when stocks are rising. That dullness is the feature. Money with a near deadline is not supposed to win a performance contest. Do not assume bonds can never fall. Prices can decline when rates rise, and longer maturities generally move more. Understand duration, credit quality, and whether you can hold to maturity before calling something safe. Safety is not one product. It is the relationship between the asset, the deadline, and the consequence of loss. The right question is not, can this earn more? It is, can this money be there when required? Near-term money deserves certainty because its deadline cannot wait for a rebound. Review retirement contributions without making fear your advisor. If your employer offers a match, abandoning it can mean giving up compensation. But no contribution rate is sacred if you cannot pay essential bills or are relying on expensive debt. Keep long-term investing separate from emergency liquidity. Retirement accounts may involve taxes, penalties, or lost growth when tapped early. A cash reserve protects those accounts from becoming the first response to every crisis. Avoid checking balances all day. Repeated exposure to red numbers can create the illusion that action is required. Markets update constantly. Your financial goals usually do not. If you change contributions, define when you will review the decision. Temporary reductions can become permanent through inertia. Put a date on the calendar and specify the conditions for restoring the plan. Retirement resilience comes from savings rate, time, diversification, fees, and behavior. Predicting the next crash receives the attention. Staying invested through many uncertain years usually does the heavier work. A contribution plan should support the household, not force new debt to preserve appearances. Update beneficiaries, estate documents, and emergency contacts. Financial preparation is incomplete if the right assets cannot reach the right people or nobody knows how to manage the household during an illness. Check retirement accounts, life insurance, bank payable on death instructions, and transfer on death registrations where appropriate. Beneficiary designations can control assets outside a will, so outdated names can create painful surprises. Create a simple inventory of accounts, debts, policies, key documents, and trusted professionals. Do not include passwords in an unsecured file. Record where secure credentials and original documents are stored. Choose a trusted person who can find the plan. Explain what bills are automatic, which accounts fund them, and whom to call. This conversation is uncomfortable because it makes risk real. That is exactly why it matters. Review the plan after marriage, divorce, birth, death, relocation, or a major job change. A document that reflects an old life can be worse than no document because it creates false confidence. Clear documents prevent grief, delay, and confusion from becoming additional financial costs. Harden your income, not only your portfolio. For most households, future earnings are the largest asset. A market decline hurts. A lost paycheck can force you to sell into that decline. Update your resume, work samples, licenses, and references while you are still employed. Reconstructing years of achievements after a layoff is harder, especially when access to company systems disappears immediately. Maintain professional relationships without asking for favors every time. Share useful information, congratulate people, and stay visible. A network built only when you need rescue rarely feels strong. Add one skill that increases employability or reduces dependence on one employer. Choose something linked to real demand, not an expensive certificate marketed through fear. The skill should improve income, mobility, or bargaining power. Know your unemployment benefits, severance terms, unused leave policy, and health coverage options before a job loss. Preparation cannot guarantee work. It can shorten the period in which confusion controls you. Employability grows quietly through proof of useful work, strong contacts, and current skills. Build a small second stream of income carefully. The objective is not to become an exhausted entrepreneur overnight. It is to reduce the damage if one source pauses. Start with skills or assets you already possess. Tutoring, repair work, freelance services, seasonal work, or renting appropriate equipment may require less capital than launching a complicated online business. Calculate the true hourly return after platform fees, supplies, taxes, travel, insurance, and unpaid time. Revenue screenshots are not profit. Some side hustles mainly transfer vehicle wear and personal risk onto the worker. Avoid borrowing heavily to create backup income. A second business funded by high-interest debt can become another fixed obligation. Resilience should reduce dependence, not multiply it. Protect your main job performance while testing alternatives. A side income that causes burnout, conflicts with employment rules, or damages health may weaken the asset it was meant to defend. A second income source is strongest when it begins small and survives honest arithmetic. Review health insurance, prescriptions, and medical records before disruption. Job loss can change coverage, networks, and costs. Waiting until medication is nearly gone turns paperwork into an emergency. Know where to access policy numbers, provider contacts, vaccination records, current medications, and recent test results. Ask how to obtain refills and what lower-cost generic or therapeutic alternatives may be appropriate. Use preventive care you are already paying for when medically appropriate. Delayed dental work, ignored maintenance medication, or untreated vision problems can become expensive at the worst possible time. Do not stockpile prescription drugs outside medical guidance. Some medications expire, require controlled storage, or are dangerous when misused. The safe goal is continuity, not a private pharmacy built from panic. Include mental health in the plan. Financial stress can damage sleep, judgment, and relationships. Identify affordable support, crisis resources, and trusted people before pressure makes every choice feel isolated. Continuity of care protects both health and the household budget during employment changes. Handle essential maintenance while parts, credit, and income are available. A failing battery, worn tire, leaking roof, or neglected furnace rarely becomes cheaper after it breaks. Create a maintenance calendar for the car, home, appliances, and safety equipment. Small inspections can reveal problems while you still have time to compare prices and choose a repair. Prioritize failures that threaten safety, housing, or earning power. Cosmetic upgrades can wait. A reliable vehicle used for work may deserve attention before a beautiful kitchen feature. Keep manuals, model numbers, warranties, and receipts. Contractors and repair shops can work faster when you provide accurate information, and warranty claims depend on proof that most people cannot find. Learn a few safe basic repairs, but respect the limit of your competence. A tutorial does not make electrical, gas, structural, or automotive work harmless. Saving money is pointless if the repair creates injury or greater damage. Preventive work is rarely exciting, but breakdowns do not wait for convenient timing. Now move to the grocery store, where economic pressure becomes visible every week. Stop comparing shelf prices alone. Compare the unit price, package weight, and amount your household will actually use. A larger package can have a lower unit cost, but only if it is consumed before spoilage. A sale is not savings when half the food enters the trash. Waste is a price you pay after checkout. Keep a short price book for frequently purchased staples. Record normal unit prices at the stores you use. This turns a bright sale tag into a testable claim instead of a command. Federal data for June 2026 showed food at home up 2.7% over the year, but categories moved differently. Weather, disease, fuel, labor, trade, and herd cycles change prices, so substitute instead of surrendering. Plan meals around what you already own, then shop the gaps. The pantry should guide the list. Without that step, Households buy duplicates, forget perishables, and discover the missing ingredient only after another trip. The unit price reveals what colorful tags and familiar package shapes are trying to blur. Watch for package downsizing. A familiar box may keep a similar price while containing less. The front design can remain almost unchanged, so the increase hides in the weight and the unit price. Do not assume downsizing is illegal or secret. Package sizes change for many reasons, and the net quantity must be disclosed. The consumer mistake is relying on memory instead of reading the label. Compare servings realistically. A package may advertise many portions using a serving size smaller than your household eats. Cost per practical meal can matter more than cost per official serving. Keep old receipts or photographs for products you buy often. You do not need a giant database. A few comparisons can show whether a promotion is genuine, a size changed, or your memory is wrong. When a favorite product shrinks, consider a substitute, a different format, or buying less often. Brand attachment is expensive when it prevents comparison. Reading the weight is a simple defense against paying more for less without noticing. Understand the store layout. Staples may be placed around the perimeter or spread across aisles, while high-margin convenience items compete for attention at eye level and near checkout. End caps and special displays do not guarantee the lowest price. Placement is advertising. Compare the displayed item with alternatives in its normal aisle and check whether the promotion requires a quantity you do not need. Shop with a list organized by store section. This reduces wandering, repeated aisles, and exposure to more prompts. Retailers are good at converting extra minutes into extra items. Do not shop hungry, rushed, or emotionally depleted when you can avoid it. Decision fatigue makes convenient products feel necessary. A simple snack and a clear list can be a financial tool. Pause before the checkout zone. Small drinks, snacks, batteries, and seasonal items are positioned for low-friction decisions. Ask one question: would this have made the list at home? Retail space is designed to influence attention, and attention often becomes spending. Use loyalty programs with open eyes. Member prices can be real, but the discount may require surrendering purchase data, loading a digital offer, buying a specific quantity, or remembering an expiration date. Do not let a loyalty price define value. Compare the final unit price with competing stores and private labels. A dramatic discount from a high reference price may still leave the product expensive. Check the receipt before leaving. Digital coupons can fail to attach, quantity conditions can be missed, and shelf labels can be read incorrectly. Correcting an error is easier while the cart and sign are nearby. Protect the account with a unique password. Loyalty points and stored payment methods have value. A reused password can turn grocery savings into another path for fraud. Use the program when it reduces the price of planned purchases. Ignore it when it pulls you toward products, quantities, or trips you would not otherwise choose. Loyalty should work for you, not manage you. A discount is useful only after every condition, comparison, and receipt is checked. Test private label products category by category. Store brands can cost less because marketing and product positioning differ, but quality is not automatically better or worse. Compare ingredients, nutrition, size, origin when relevant, and return policies. Some private labels are produced by large manufacturers, but the exact supplier can change and should not be guessed from packaging. Start with low-risk staples such as basic pantry items or cleaning supplies. If the household accepts the substitute, the savings repeat without requiring constant coupon hunting. Keep the brand name where performance, allergies, medical needs, or strong preference justify it. Extreme frugality fails when people hate the product and buy the favorite later anyway. The strongest grocery strategy is selective loyalty. Pay for differences you can taste, measure, or depend on. Refuse to pay for a logo when the difference exists mainly in habit. Changing one acceptable staple can save money repeatedly with almost no extra effort. Treat coupons as price tools, not permission slips. A coupon saves money only when the final price beats the best acceptable alternative and the product was already likely to be purchased. Check quantity requirements. Buying several units to unlock a discount can drain the weekly budget and create waste. The per-unit deal may be good, while the household cash decision is bad. Stack offers only when the rules allow it, and avoid spending hours to save a trivial amount. Your time has value. A simple, repeatable system beats a complicated ritual that collapses when life gets busy. Stock up on shelf-stable staples during genuine lows, within storage and budget limits. Rotate older items forward and record what you have. A hidden pantry is not a reserve. It is forgotten inventory. Never finance a stockpile with credit card debt. Paying high interest on discounted food reverses the bargain. Preparedness purchased at a punishing rate is not preparedness. Planned discounts build savings. Unplanned discounts merely decorate overspending. Reduce delivery and convenience leakage. App prices can differ from in-store prices, and the final bill may include service charges, delivery fees, small order fees, tips, and impulse additions. Convenience has real value for disability, caregiving, time pressure, or transportation limits. The mistake is pretending it is free. Compare the full cost with pickup, planned trips, or a simple backup meal at home. Delete saved carts after ordering. Apps are designed to keep the next purchase close. Notifications can turn boredom into a restaurant bill before hunger has even been considered. Build a 10-minute meal shelf with foods your household will actually eat. Pasta, rice, beans, soup, frozen vegetables, eggs, or other simple options can compete with the moment when delivery feels inevitable. Reserve delivery for situations where its value is clear. When convenience becomes automatic, the premium disappears into routine and the household loses the ability to choose. Convenience should be a conscious purchase, never an invisible default setting. Question premium products and price anchors. A very expensive option can make the merely expensive option feel reasonable, even when a basic version meets the same need. Words like artisan, reserve, natural, professional, and limited can signal real differences, vague positioning, or both. Read the specific claim. Packaging language is not a substitute for evidence. Compare function first. Does the premium detergent clean better per load? Does the specialty snack provide something you value? Does the upgraded tool last longer? The answer may be yes, but it should be demonstrated, not assumed. Avoid prestige spending disguised as preparedness. Expensive survival gadgets, luxury food buckets, and dramatic equipment can consume money that would provide more protection in cash, insurance, maintenance, or debt reduction. A resilient household is not the one with the most impressive supplies. It is the one whose purchases solve likely problems at reasonable cost. Premium pricing deserves premium proof, especially when household cash is under pressure. Buy in bulk only after checking unit cost, storage, consumption rate, and cash impact. Warehouse packaging can save money, but size creates its own pressure to consume. Shared bulk purchases can work when expectations are clear. Divide costs, quantities, and storage immediately. Informal arrangements become irritating when one person pays and everyone vaguely remembers. Beware of variety packs filled with flavors nobody wants. The attractive average price hides expensive leftovers. The best unit cost is meaningless for units that remain untouched. Use a first-in, first-out system. Date opened packages and rotate cans, frozen food, batteries, and household supplies. Preparedness becomes waste when the oldest items are trapped behind the newest. Track what is thrown away for 1 month. The trash often reveals more than the receipt. Overbuying produce, repeating unpopular meals, and ignoring leftovers are purchasing problems wearing a disposal label. Storage turns a bargain into savings only when the entire purchase is eventually used. Build a measured reserve of essential household goods. Focus on items whose absence creates immediate difficulty. Water, basic food, hygiene supplies, batteries, pet needs, first aid, and medically appropriate necessities. Follow public emergency guidance for local hazards, but adapt it to your household. Climate, evacuation routes, infants, older adults, pets, mobility needs, and medical devices change what is essential. Buy gradually during normal shopping instead of emptying shelves during a scare. Panic buying raises stress, strains budgets, and takes goods away from neighbors who may have immediate needs. Store supplies safely and inspect them. Water containers, fuel, medicines, chemicals, and batteries require appropriate conditions. Never mix products or improvise storage that creates fire, poisoning, or contamination risks. Include copies of identification, insurance, contacts, and evacuation information. An emergency kit is not only food. The documents that prove who you are and what you own can speed recovery. A calm reserve is built for realistic disruptions, not for performing fear in public. Expect scams to increase when markets fall. Fear creates urgency, and urgency weakens verification. Promises of guaranteed returns, secret government programs, instant debt relief, and risk-free rescue deserve suspicion. Never move money because a caller says an account is in danger. End the call and contact the institution through a verified number. Caller identification, logos, and familiar names can be spoofed. Be cautious with links in texts and emails about refunds, deliveries, taxes, benefits, or frozen accounts. Open the official app or type the known address yourself instead of following the message. Discuss family verification words for urgent requests. Artificially generated voices and compromised accounts can imitate people you trust. A private phrase and a return call can interrupt the emotional trap. Slow down when someone demands secrecy, gift cards, cryptocurrency, wire transfers, or immediate access to your computer. Real institutions may act urgently, but they do not require you to abandon basic verification. Verification feels slow only until one rush decision empties an account. Create a household response plan for bad economic news. Decide who reviews accounts, who contacts insurers or lenders, which expenses pause first, and what loss of income or savings triggers action. Rehearse the first week instead of improvising it. Agree that nobody makes a major trade, withdrawal, loan, or purchase while panicked. Use a cooling-off period and a second review for large decisions. Talk honestly about how much help can be offered to relatives without endangering essential bills. Choose reliable information sources and limit outrage. Economic content is often rewarded for certainty and fear, not accuracy. Nobody can promise an imminent collapse, and nobody can promise one will never occur. Prediction is a weak defense. Your strongest protections are accessible insured cash, reduced costly debt, appropriate diversification, protected near-term money, adaptable income, maintained essentials, and grocery habits built on unit prices rather than bright signs or brand attachment. Do not let fear push you into hoarding, leverage, scams, or panic selling. Like this video, share it with someone worried about the next downturn, and answer this in the comments. Which of these 30 defenses will you put in place before your next paycheck arrives? A shared plan keeps one person's fear from becoming the entire household's strategy.